Tegs Harding, welcome to this Sustainable Investor Asset Owner interview.
Thanks, Chris.
Um, you are a trustee at a number of pension schemes of different types, and they've got a range of challenges, some of which are sustainability related and some not, and we'll be discussing quite a few of them today. But before we start, I'd like to hear from you, perhaps, your kind of definition of what it means to be a trustee today.
Yeah, absolutely. So I'm independent trustee at Independent Governance Group, where I'm also head of sustainability. And I got that role really because the clients that I had all had strong interest in sustainability. So went through the journey very early in terms of setting net zero goals and how those are kind of evolving over time. I'm a trustee on different types of schemes, and your objectives and what you're really trying to do as a trustee vary depending on the type of scheme. So in defined benefit schemes, it's very straightforward. You're trying to deliver those benefits as promised and maintain your solvency, working on your end game specific to your covenant and the situation. Obviously, that's then different in the DC Master Trust space, where I'm also a trustee. There because your investment decisions are obviously directly linked to members' outcomes.
Mm-hmm. Okay, great. So we're at a stage where there's the UK government has quite an ambitious program of change and reform involving consolidation, private markets, decumulation, value for money, a lot of different factors. When you take them as a whole, where do you see the kind of biggest challenges and opportunities?
Yeah, so I think taken individually, they all seem very, very sensible and supportive of that direction of travel. I think the challenge is going to be implementing them all in a short time frame and the costs of that. And I think in some cases, the ordering hasn't been thought through particularly well. So to give you an example, in the DC space, we're expecting some regulations around CDC schemes, multi-employer CDC schemes, but those aren't due to come out until after the regulations around how you need to put a default in retirement together. But both of those projects would require, significant investment, not only in the product itself, but the sort of operational aspects of that behind the scenes, how it fits with the member journey, how members see it on their app, all of that kind of thing. And what you wouldn't want is to go through a big project to put a default in, only then have to do it again and rip it up a couple of years later, which might actually put back the number of people that are willing to look at CDC because of the ordering of some of that kind of stuff. And you've got similar ordering problems with other bits and bobs of the regulations as well. So there's a big drive for consolidation of DC schemes, which I completely understand some of the rationale behind. Yet at the same time, the government's trying to push those same DC schemes to invest in private markets, which of course, once you buy in, you can't sell, or certainly not very easily, without taking big haircuts. So that means doesn't fit together very well, because if you're a DC scheme that's going to consolidate in a few years, the last thing that you should be doing is buying things that you can't sell.
Mm-hmm, mm-hmm. One of the upsides, I suppose, of that consolidation push is the scale and the ability to kind of co-invest and this kind of thing. Presumably that there are significant upsides to that.
So yes, I think essentially when you're investing in private markets, you want to pass as much of the benefit of doing that on to members as you can, and that essentially means doing it cheaper. And co-investments are one of the things that are opened up with scale. And allow you to sort of pass more of that benefit on. So yes, I do think there are certain situations where scale gives you that sort of cost and operational advantage. There are also some a kind of more abstract benefits that I think it brings, which is kind of the rationale for building out internal teams with that specialist skill and resource. So less of that is kind of outsourced.
Mm-hmm, mm-hmm. So is the process well underway at the schemes that you're familiar with in terms of building that resource and the expertise across the trustee board and the teams at the schemes in order to be able to take advantage of these opportunities.
Yeah, absolutely. But I think it does vary depending on the scheme. So I'm a trustee on the Legal and General Master Trust. We have our Lifetime Advantage Fund, which has a 15% allocation to private markets. And that's a multi-asset private market fund, which Legal and General have built out. And that's been open for a year now, and it's been performing perfectly in line with our expectations, which is really good to see. Been able to deploy that capital sort of as expected. So a lot of that plumbing has already been put in place in terms of the fund structure, thinking about how it all works and fits together from a member perspective. But our master trust is 40 billion, so we're kind of already at the sort of scale that the government's thinking about.
And also, that's I guess that's also kind of reflected in the makeup of the trustee board, making sure that the kind of the skills are in place and the areas of expertise.
Yeah, absolutely. I mean, one of the reasons, so a lady called Lois Day was the last trustee to join our board. And the reason that we brought her in is because she's got a background in private equity and venture capital. So it's brilliant to have that sort of direct experience on the board as we move more into that area.
One of the areas where there might be potentially tension in terms of the government's agenda is the push for value for money, and obviously there's a consultation about how to arrive at that in the long term, and whether there's tension in kind of driving long-term value and obviously particularly in relation to sustainable investment. Are there necessarily tensions there?
Yes, and I think the ambition behind the value for money framework is obviously when every trustee is going to be on board with it. As a trustee, that's your whole job, is ensuring members get value for money. There are some issues with the methodology, and I think it doesn't necessarily allow for the nuances in how you would construct a fund. So when you're thinking about how you set investment strategy, one of the first things that you're going to want to look at is your member needs. So what do they actually do at retirement? How big are their pots? And that informs your need for liquidity and the risk tolerance that you've got within there. That would then drive what level of diversification, what level of private markets that you want in there, and what kind of pattern of returns that you want it to draw over time. And the risk that you've got with the methodology as it's set out in the consultation is it ignores all of those factors. So I give you an example to make it a bit more real. If we took the cohort that's closest to retirement, so 5 years from retirement, if you have one master trust with smaller pots where the majority of members are cashing out either at or around retirement, you've got quite high liquidity needs in there and a lower risk appetite because people don't want to see the value of that drop. Whereas if you have a master trust which is aiming in for drawdown in retirement, you're naturally going to want to have more risk in that portfolio than the other one. And yet the framework as it stands doesn't allow for any of those nuances, despite the fact they're both very well designed around your member needs. Unfortunately, the lower risk one will be penalised under the framework as it stands.
Are you hopeful that the consultation process will iron out or address some of these issues?
I am, yes. And actually, the trustees are putting their own response together on this. I think there's a danger more widely with it. So it's not just the example that I gave. One of the other issues that we had with it as a board is the use of arithmetic performance rather than geometric. Sorry to get a bit techie on you, but so arithmetic generally favours more volatile strategies because it smooths out the impact of any 1 year of bad performance. So if you had a fund that was up 20, then down 20, the arithmetic performance number you'd report is 0, whereas the geometric one is -4. Okay. And then if you compared that to a strategy which took a more nuanced approach to risk, perhaps had greater diversification in it, that perhaps the board were really aware of the concentration to AI stocks or the concentration in the US, they wanted to spread those risks out a bit, they might have a pattern that looks more like plus 15, minus 15. Now, the arithmetic would still be zero in either case, but if you look at the geometric one in there, it would be minus 2 in that case. So there's a real difference between how volatile strategies, how attractive they are under this framework because of the specific way that you have to calculate things.
Mm-hmm. If we're talking about tensions arising from policy shifts, I think perhaps we ought to move on to perhaps what one of the biggest policy shifts relating to sustainable investment is over the recent years, which is essentially the breakdown of the global consensus on the necessity to follow the Paris Agreement and take the necessary steps towards net zero. Now, effectively, policymakers have not delivered on the promises that have formed the basis of asset owners' decarbonisation strategies. What problems does that pose?
Well, it could be one of the reasons that sustainability doesn't feature in the value for money framework, for example, which it doesn't. And I think if you took the point in time where lots of schemes, including my own, were setting these targets in the first place, sort of 2020, 2021, the world looked very different. The world's largest economy was signed up to the Paris Agreement. That's no longer the case. And in that interim, we've been able to see that if you were measuring progress purely on emissions in the atmosphere, you'd conclude it was not working at all, that we hadn't made any progress because that line has gone up every year. There obviously has been progress, particularly on the technology side. Renewables are much cheaper, much more widely deployed than they were in 2020, so that there are those pockets of success, but they're very much technology driven rather than legislation driven. And what that means is the whole transition is both too slow and very uneven geographically, which makes it very challenging to invest through those sorts of conditions. And particularly where you have things like automatic decarbonisation, so funds that embed that decarbonising in line with what the Paris Agreement would have implied, you're getting a unintended risk arise as the world fails to decarbonise along that pathway. So portfolios are going much quicker than the real world is. And that's leading to kind of secondary concentrations of risk that nobody expected when these goals were set in the first place. So I think that there are lots of boards that are looking at what you do about that issue and how you kind of recalibrate those targets so that they make sense for the world that we find ourselves in. A big part of that as well is accepting the consequences of not transitioning as quickly as we need to, because there are going to be physical risks arising that impact the economy, anything from impacts to, water systems, on supply chains, infrastructure, all of that sort of thing. And the current methodology ignores that adaptation question. So I think that's a big area that boards are exploring at the moment as well.
Mm-hmm. Does this shift require asset owners to kind of rethink their kind of target setting frameworks when it comes to net zero? Certainly there's been a number of studies recently that have criticised the target setting of both US and Canadian pension schemes for essentially being too narrow.
Yeah, absolutely. I think there's a wide recognition that frameworks like TCFD, while very well intentioned, have caused some unintended consequences around that target setting process. And that is sort of too much focus on emissions intensity at a portfolio level, rather than going a layer down and concentrating on decarbonisation at a company level, which of course still makes sense. It just doesn't translate to portfolios very well, because there's lots of ways that you can hit that target without seeing anything in the real economy.
Mm-hmm, mm-hmm. One of the, I guess, one of the outcomes from this um, situation where policy hasn't gone at the pace that we expected has been an increase in the attention of asset owners to policy level advocacy, viewing climate change and biodiversity loss and other impacts across diversified portfolios as systemic risks, and leading to a greater deal of system level stewardship, which of which policy advocacy is a large is a large part. Clearly, the UK government has allowed for greater guidance to pension schemes. What are your hopes that might how that might clarify things for pension funds?
So I think pension schemes are already taking this responsibility quite seriously, and they recognise that they play an important part in the overall infrastructure of markets, particularly with what they're signalling to parties like asset managers and like investment advisors, that these things are really important for member outcomes, very important high up on trustee agendas. So I think that is happening. There are examples that I can think of on my own boards where policy level engagement is happening as well. So one example might be on one of my schemes, we have a book of renewable infrastructure that, as it stands, because we want to do a buyout transaction in a few years, we're going to have to sell down. Now, that probably doesn't make any sense in a world where we could pass those perfectly good assets over to the insurer. The reason that we can't do that is because of the Solvency II legislation as it stands, that means those assets wouldn't be suitable. So absolutely are engaging on that point, because that doesn't make sense from a big picture point of view. I think the other example of what is happening at the moment as well is a lot of engagement with the consultations that are going on, which there seems to be another one every week. And trustees are very engaged with sort of trying to give feedback to the various regulatory bodies on all of those to make sure that they're in the best shape that they can be. I think what isn't happening is the wider big picture policy engagement on systemic risk. And I think that's, you need to be a bit realistic about how impactful that could be when you consider just how much of institutional portfolios are reliant on the US, which are, of course, no longer a signatory to Paris. There's a very different climate around there, big pushback against all things ESG. So we just kind of need to be realistic with the expectations on trustee boards on that one.
Mm-hmm, mm-hmm. Do you think that most pension schemes are currently set up, for want of a better word, to engage at government level on systemic risks? Are there additional resources, channels that they ought to be thinking about?
Yeah, so today the vast majority of policy level engagement is done at asset manager level, not trustee level. And the ones that are doing it directly are the ones with big internal stewardship teams that have the expertise, the right backgrounds to do that engagement on schemes' behalf. So, yeah, I think that's definitely a gap, and I'm hopeful that is going to be one that is filled in a world where you've got consolidation of DC schemes, for example.
Mm-hmm. Mm-hmm. And what would you hope would come out of the government UK government promise to clarify fiduciary duty? I mean, we've already had a clarification relatively recently, but do you think that further help is needed to certain types of pension schemes?
Yeah, so I actually changed my mind on this one. So initially, when Share Action first started talking about this, I was skeptical that it was necessary, because I thought the current definition was permissive. However, there are different legal positions out there, and in a world where the government wants schemes to invest in the UK, to invest in productive assets, it makes no sense that there's this question mark over what a trustee's fiduciary duty is, and you've got these differences in legal opinion. I think that the challenge is going to come when, if we are going to get guidance on this, on how that guidance is tailored for the different types of schemes. Because what you need to think about when you have a small closed DB scheme is very different to what you need to think about if you're a trustee on a 100 billion open DC scheme, where those investment decisions have direct impact on member outcomes. And those are two very different things. So I think the devil's going to be in the detail, to use a slightly cliched phrase.
You mentioned that on the policy advocacy side, that a lot of work is done at the asset manager level rather than directly by asset owners. And we also know that in a lot of cases that investment consultants are influential with the strategies of pension schemes. And there's been a number of reports and analyses recently kind of pointing out how the climate models that have been widely used by investment consultants and across the finance sector somehow were very much undersold climate risk, potentially delaying or diluting some of the actions by pension funds. Do you feel that we've gone beyond that point where there's too much reliance on external advisors on pension schemes?
I think that the conversation's moved on slightly. I think there is now wide acceptance that the scenarios, especially ones that were based on the NGFS scenarios, just completely undersell climate risk. So they had the impact on asset returns in a hothouse world being, a half 1%. It's just absolute rubbish. And I think people recognize that now, that they ignore tipping points, that they kind of understate some of those systemic risks. And there are pockets of alternatives that people are using, but they're more along the sort of narrative scenario lines. But they do take quite a while to develop, to make scheme specific. And even when you do, there's still quite a challenge on how you make those decisions useful. And the problem with it is they very much look at the investment problem top down, whereas to be of any use, they really need to be bottom up, especially in a world, we know 1.5 degrees is sadly in our rear view mirror. And we're going to see the consequences of that in terms of extreme weather, which is going to test infrastructure, test supply chain, test our economies more broadly. But it's not going to do so in a uniform way that fits into those top-down models. And your exposure to those risks is going to differ depending on where you are in the world, what you do, whether your assets can be moved or not. So there's a huge difference in terms of physical risk between a services company and someone that's, say, a miner, because you can't move a mine, right? So to be useful, that sort of analysis needs to be bottom up by its nature. The scenario analysis that goes into the reporting is top down. So you're just never going to be in a place where those two square up nicely.
Okay, fair enough. Did you going back to the where we started the conversation and the role of the trustee, in recent years there's been ongoing increase in expectations on trustees, the skills they need, etc. Looking forward, how different do you think your role will be in 5-10 years' time?
So because I tend to work with the bigger schemes, I honestly don't think it will be that different. And if I think about how the Master Trusts in particular fill vacancies on their board, we do a board effectiveness study every year. We look at the skills of everybody on that board and try and make them complementary. So rather than being everybody on the board is a generalist, you want kind of a deep pocket of expertise in one area, as well as sort of contributing to the more general questions. And I don't see that being particularly different as we move forward. Where I do see differences is the amount of resource and support that you have as a trustee. So if I take the very big pension schemes as an example, the sort of Nests and the Railpens of the world, they have very large internal investment teams, which give them that kind of deep pool of specialist knowledge that they can draw on. And I think you're going to move towards that model as we go through the consolidation phase.
Mm-hmm. Okay. Well, Tegs Harding, thank you very much.
You're very welcome.